Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 184th VideoCast, 174th podcast for the week ending April 27th, 2023. Got a lot of great stuff to cover today, so we'll quickly do the media. Want to thank Mike Teak and Ann Berry for having me on Public to talk markets. You can check it out there. Also want to thank Deborah, Mary, Sophia, and Bansari Kamdar for including me in their article on Reuters. And finally, I want to thank Jonah Lupton for having me on his podcast, Investing with the Whales. You want to check this out. As a matter of fact, we're going to go to it right now, but I'm going to just show you. You can look him up on YouTube here. Just put in Lupton Capital. He's done some great episodes with Rana and Sana. Those of you who remember, he's a broadcasting legend from CNBC. He did one with, I think, Dan Ives, the tech analyst Dan Ives from Wedbush, who's a great tech analyst. So some good stuff here. But let's get right to it, because in this segment, I cover Alibaba, 3M, Amazon, Google, Vornado, Intel, a whole handful of our positions. We get into good detail, and he really asks good questions. So you want to check it out. Here we go.
This episode is sponsored by Lupton Capital, which provides a variety of investment services to both retail and institutional investors on platforms such as Seeking Alpha, Substack, and StockTwits. For more information on these services or for links to those services, please visit luptoncapital.com.
Hey, everybody. Welcome back to the Investing with the Whales podcast. My name is Jonah Lupton. I am your host. Please help me welcome our guest today, Tom Hayes. He is the chairman and managing member or partner of Great Hill Capital.
Yeah, that's right. Managing member. Great to be with you, Jonah. Thanks for having me.
There you go. Now, Great Hill Capital is a long-short hedge fund.
Yeah, we run separately managed accounts for ultra high net worth and small institutions. We're kind of value oriented, but quality value with growth. We don't like to be bagged in value traps. So we could talk a little bit about that. But we like compounders that are out of favor.
Give us an example. I mean, I'm not sure if you can talk specific positions or not. Hopefully.
Yeah. Well, I'll give you an example that's been pretty controversial for the last 6 months or so. Is Alibaba. Okay, no one wants to touch it with a 10-foot pole. This is a business that you can buy at IPO prices from 2014. They've compounded capital at double digits throughout that entire period. They've grown revenues 800%. They've grown earnings and cash flow 500%. And you can't give the stock away, and you can buy it at the same price 14 years ago. So you could say, well, the multiple was too high when they were an IPO. Okay, that's fair. But it's certainly too low now when you consider the sum of the parts. So the overhangs obviously are geopolitical, some trade war rhetoric with the politicians. You had the country basically locked down and people locked in their apartments literally for 3 years, and that's changing. And people are like, wait a second, the country's reopening. Why haven't all their numbers doubled? But they've been reopened for 12 weeks. So we are seeing it last week with the GDP numbers shot the lights out. The retail sales numbers shot the lights out. And that's why we're not only constructive on businesses like that. We think this is one of the most no-brainer discounts to intrinsic value globally, okay, in terms of an equity business. And now that they're breaking it up, they have the ability to IPO different pieces of the business. You're going to see that. I mean, just today, there was an article in the South China Morning Post that Alibaba has 36% share of the cloud market. They just signed another big deal with a state-owned enterprise, which is an implicit nod from the government, which is a very good thing to see. And the cloud business is going to triple by 2025, if you believe McKinsey's industry outlook, which we do. So at 36% share, I mean, that business alone is going to increase operating cash flow by 66% above where it was trading when it was trading at $319 a share. So those are the type of things, and we're willing to sit through these periods of extreme despondency and pessimism. So we're kind of acolytes of Ben Graham and Warren Buffett. It's a voting machine in the short term. It's a weighing machine in the long term. And we've attracted the type of partners that are 100% on board with that and understand intrinsic value of a business. And we don't get swayed by day to day or week to week prices, provided nothing has changed in the underlying business operations. And if anything, the underlying business operations have improved in spite of one of the worst environments, once in 100-year events when you consider COVID. So we like that type of business, and there are a couple others that are probably going to cause some surprise and awe amongst your audience as we go through them.
So real quick, I mean, I've been around for over 20 years investing. I've seen companies break up into 3 pieces. I've seen companies spin off units, like Johnson & Johnson right now is, doing their roadshow for one of their healthcare units. They're going to spin off. I've never seen a company break into 6 pieces. Like that's pretty wild. So is it going to be individual IPOs they spin off one by one, or are they just going to break up the company? And if you own BABA shares, now you're going to own shares in 6 different companies?
Yeah, it's been unclear, and we'll get more color on earnings. However, we are seeing the early stages, like Freshippo, which is the kind of the equivalent of Costco in China, that owners have attributed basically zero value to this business. That could be the next Costco in the fastest growing, largest market. So they're IPOing that alone for $10 billion valuation, and that's just get out of the gate. And then they can raise capital. So I think initially they're going to do a few of these IPOs, and they're going to hold major ownership stakes in it. So you'll get that benefit through your ownership of Alibaba. And then I think there will be some that get spun over time, and that's a good thing. If you've been around, Greenblatt's Little Book That Beats the Market. You can be a stock market genius, where he talks about the empirical data about how spinoffs outperform the parent over time, because initially they get sold off by institutions who don't want to own it, but they're set up and they tend to dramatically outperform. So we love spins. We love this concept.
I wish we saw more of them in the US. Like, for instance, maybe not Apple. I mean, I guess Apple could break off, services unit, for instance, but I think like Amazon could spin off AWS. Microsoft could spin off something, because they're such a conglomerate in so many different areas. Of course, Meta could spin off Instagram, and Google could spin off YouTube. I don't think those companies would ever do it on their own unless they were forced to by, Congress, regulators, and whatnot. But it would be exciting to own some of those parts rather than the whole company.
Yeah, I agree. I mean, when you consider Amazon, which we also hold, by the way, so we like, Amazon was down when we bought it, I think 55% off of its pandemic peak. We're coming into earnings here. We own Alphabet, I think, got down like 50% off of its pandemic peak. We don't own any Apple. We don't own any Microsoft. They just didn't get cheap enough for us. I think you get
I'm the same way. If I had to own any of the mega caps, and I don't own any right now, but I think Google and Amazon are the 2 that I would own.
Yeah. So you have a similar type of bent in that you like quality, but you like it marked down, and that was the opportunity served up. So we missed Nvidia, but Nvidia we just couldn't get our arms around. We bought Intel at 25. It's now at 30 to 32. I don't know what it is today. So we're not betting on Gelsinger's pipe dream, which, by the way, we think is actually more than a pipe dream. We actually think if anyone can deliver on the outlook, it would be Gelsinger. He was schooled under Grove, the guy who basically built Andy Grove, who basically built Silicon Valley. So this is a guy, when you think about the 486, he architected that. And our initial play is, okay, we know that inventory is built because all the PC and server demand got pulled forward to 2 or 3 years ago. That's a no-brainer. We're at the point, and from the data that we look at, that inventories are at peak or close to peak. So just on their commodity server and PC business, which they control, certainly PCs, we think we're at the tail end of that inventory peak. And just on that alone, there's a lot of juice in the stock. And then if Gelsinger actually delivers on being able to design and produce these high quality chips that are going to be beneficial with AI and some of the things that
They're gonna
Nvidia is
say,
doing.
AI is the magic word.
Yeah, and that's a free option, and I'll believe it when I see it. But in the meantime, I can make off of $25, I can make, at least a double over 3 years. That's worthwhile. And then if Gelsinger's promises are anything close to true, maybe you have a $90-$100 stock 3 to 5 years out. That's pretty valuable with downside protection and so stuff like that.
Why do you like Amazon? So I did own Amazon off of the lows and then sold it, just, take a quick profit. And I just believe it's going to be a pretty strong free cash flow story over the next 3, 4, 5 years. Why do you guys like it?
Yeah. So, I mean, when it was down 55, it was basically trading at 2018, 55%. It was trading at 2018 levels. However, they tripled the ad business. They tripled the AWS business. They had doubled the e-commerce business. They had grown Prime subscribers from 100 to 165 million over that period. So you're getting, double to triple the business for the same price, number one. So you could say, well, it was overvalued in 2018. So where did they screw up? They screwed up because demand went through the roof during COVID. They overexpanded the warehouses. They overexpanded the hiring. They overexpanded the costs. And they're now paring all of that back. And we're seeing them, shut that down, lay off people, et cetera. And then you're compounded with the fact that enterprise spending slowed in Q4 particularly. We're seeing some little green shoots. Maybe things got a little better in Q1, but let's not have any faulty expectations. Let's assume Q3, Q4, Q1 of next year, it starts to come back. So we look forward to their guidance this week. My guess is it will be murky. And if it's anything less than murky, the stock could get bid. But a week to week or a few months, it's, we bought it with a large enough margin of safety. If it retraces the recent bounce and retest before it goes higher for the long term, we can live with that. But if you get any upside surprise, because expectations are so low, I was joking on a hit that I did that the key to happiness in life is low expectations. It's also the key to happiness in earnings season. And expectations couldn't be much lower coming into this earnings season, negative 6.3%. So if they say anything along the lines that enterprise spending could be firming up on the AWS, this thing could get a nice bid.
I mean, could they pull, because Meta stock got hammered after Q3 earnings because they really didn't lower their CapEx spending expectations. And then a couple of weeks later, they came out and said, okay, we're going to reduce CapEx. We're going to do our first, reduction of the workforce by 13,000 or whatever the number was. And they've done a couple rounds since then. Is that sort of Amazon's moment right now to do something similar?
I agree with you. And I think they've been doing it preemptively coming into earnings. So if their results are not where they think the street wants them to be and where investors expect them to be, probably the way to salvage that would be to do another announcement in concert with bad earnings. And people will say, okay, they're on top of it, they're fixing it, they're going to get their margins back. But that might be a rear view mirror story. And I think maybe we'll see, no one has a modicum of positive expectations going into the call. So they'd really have to do terrible things and have terrible guidance for the stock to get pounded in our view. And if you have something positive come out, whether it's guidance, whether it's margin improvement, whether it could be a multitude of things, or Prime subscribers, et cetera, any of those things could be like people say, well, the business is actually no longer deteriorating. They're getting their costs under control, and give them the benefit of the doubt of the next couple quarters of softness. And you could find a bid in the stock. But we're looking at this in terms of, we bought it down 55%. Our view was over 36 months, we could have a double. And if we're lucky, maybe a little more than that. So if it goes down before it goes up, not the end of the world. If it goes up now and it happens faster than we expect, that's great. We have enough taxable accounts. We'd rather it takes over 12 months to get the double.
So when you guys start a position, are you typically looking at it as a potential 2-3 year hold?
Yeah. In client accounts, we want to be, our horizon is 12 to 48 months. If we're right, we're usually out in 24 months. If we're wrong, it takes 36 or 48 kind of thing. And, but, back to the point about the market being a voting machine and a weighing machine, all you can do is your analysis of the underlying business and your analysis of what the actual intrinsic value is relative to where it's trading in the marketplace. It's funny. I was talking to a good friend. We were at a hockey game this weekend, and we were talking about Florida real estate. I was like, why don't you just go around to like 10 properties and just offer like 0.60, 60% of ask, and see what happens. Because their prices started to come down like 10, 12%, whatever it was in the Case-Shiller in his area. And he's like, I just can't look people in the face and do that. I feel terrible. I was like,
you might get punched by somebody.
Yeah. And I said, well, you have no problem buying Alibaba at a 33% of intrinsic value. Why would you have a problem offering 0.6x of a home value? I was like, that's what email's for. Send the offers. Out of 10, you may get one. You may get one at 0.7x. But what I love about the public markets more than the private markets, the bad news is you get mark to market every single day. The good news is you get offers laid out to you, Jonah, that would never be seriously considered in the private markets. If you went to, if JP Morgan said, listen, we're going to give you a credit line. If you can find a high quality business to buy at 33% of intrinsic value and you can prove it out to us and it's a proven business, we'll extend you $200 billion, go buy a business that's worth $600 billion or $1 trillion. And you walked into Alibaba's boardroom and you said, look, I'd like to offer you $200 billion for the 6 parts of your business. Would you be interested? They would cart you out with security. Like if you offered them the amount that the business is trading in the market right now, you would be like probably arrested by the Chinese Communist police. Like it would be so insulting.
You'd have to pay probably a 50-60% premium just to have them listen to you.
Just to get to the meeting.
Right.
Absolutely. You'd have to be like, look, $500 billion. I know it's under intrinsic value, but let's talk it through. And you probably come in somewhere at 600. And that's if the board was scared. If the board was logical, they'd say, look, we don't care about the public markets right now. We know what this business is worth over the next 3 to 5 years. And if you come in with anything less than a T on it, go pound sand, save your first class air miles. We're not interested.
Right. It's probably the same thing that the Facebook board would have said, at the lows a few months ago, looking at the business. Yeah, it's not a high growth business anymore, but, it still generates 40, 50, $60 billion a year in free cash flow. And all they have to do is turn a couple knobs, lay off some people, reduce CapEx, and you have a pretty profitable business again.
All right, Jonah, I got to ask you, did you eat your lunch yet? Or are you eating it after this video cast? Because I got one that might repeat on you here.
I have not eaten lunch yet.
All right. You ready for this one?
Yeah.
All right. So what's the most hated pocket of the market right now that you couldn't give away with it, to anyone? No one would take it.
SPACs?
Close.
Former SPACs?
SPACs is one, but that's kind of yesterday's news.
Cathie Wood stocks, energy maybe.
Yeah. Well, energy people are still a little infatuated, but how about commercial real estate? Would that give up your lunch? All right. So I want to talk to you about one name that during the banking, whenever there are periods of dislocation, I get really interested. Okay. When people are running out of the theater, yelling fire, I'm running in to see if someone left their wallet on the seat or something like that. So I think that's what's happened in commercial real estate. Now, that doesn't mean we don't recognize the problems coming down the pike and the $1 trillion of refinancing and the regional exposure, et cetera. But the thing about beachfront property is that it's always beachfront property. And whether there's a recession in the short term, that people don't buy as many vacation homes, they're always going to come back and they're always going to want that beachfront property. As a matter of fact, I remember the first hedge fund I worked for, the principal was a very wealthy guy, and he was telling me the story of his friend during the great financial crisis. He called up the real estate agent and said, how many properties do you have listed above $5 million? Now, this was 15 years ago, so that was a big property back then. And she said like 30. And he goes, okay, I offer 1 million on all 30. And he bought 6.
Jesus.
Okay. So the point I'm making is so there was kind of that mini banking crisis last month, and it may not be over.
You're talking, so 15 years ago, you're talking the GFC?
The GFC was the Hampton story, but I'm creating the context for this thing just so you can hold down some of your breakfast before I get into it. So basically, right now you can't give away commercial real estate in aggregate. People don't, and the worst subsector of that is office property, because people are convinced that everyone is going to work from home forever, and the game has changed, and it's secular, et cetera. So last month, when you had the banking crisis, I always look for, how do you take advantage? There's always opportunity in the crisis, and I think you live by that as well, Jonah. But I didn't want to buy regional banks because the government didn't solve the problem that they created effectively. So they jammed they raised rates 500 basis points in 12 months. They blew up the portfolios. Yes, they should have been hedging. Yes, they should have managed it. But even if you think about SVB, average duration of 5.7 years, they weren't complete cowboys. I mean, they could have managed it better, but the problem was,
they weren't buying 30-year bonds.
Right. It wasn't CMBS. They got all these deposits at the exact wrong time during COVID, and they had to put them to work in the exact worst environment when the Fed funds rate was zero. So, I mean, in some sense, they would have been. So long story short, I didn't want to do that because the only way to backstop that problem would have been to do some type of temporary guarantee on deposits. Until then, you don't know what the outflows are going to be. Now, arguably, the outflows have stopped, et cetera, but there will be.
We've seen all it takes is a couple of well-known VCs to say, get your money out, and all of a sudden you have a run on the bank, and 50% of the deposits disappear in 2 days, or something like that. Right.
Yeah. No, that's exactly it. So when you have these periods of dislocation, I don't always look to the first derivative. I look for what else could benefit. Kind of like on earnings, you probably do some type of sympathy trades. Like if Intel reports good earnings, maybe you buy Dell. Something silly.
A couple of weeks ago, On Running reported great earnings, and then you saw Deckers, because Deckers owns Hoka. Deckers started to rally off of it.
Yeah. So I didn't want to buy regional banks. So Bank of America came down enough. That was a no-brainer. We bought some of Bank of America. But the other thing we bought was Vornado. Okay. Vornado is New York City real estate. Now, this is not SL Green that has B and C properties, in ABC City or in or downtown or anything like this. This is Park Avenue. This is Fifth Avenue. This is Madison Avenue. This is where JP Morgan's building their new headquarters. This is where all the Colgate is headquartered. This is where Fox News headquarters is on 6th Avenue. So is Fifth, 6th, Madison.
Stephen Roth still running Vornado?
Yeah, he's 80, so he and his proxies. And my general view is, look, this is the best operator in the business, and I'm sure he's got the right proxies around him. If they didn't take him out on a stretcher during the great financial crisis when the banks were toast, the big banks, he'll make it through. And he sold off some properties in the last 24 months. He's got cash. He's going to be able to benefit from this. But kind of back to the Baba story, this is similar in that, and even the Amazon story, from pre-pandemic levels of 2019, the revenues for Vornado, revenues per share, are down about 4.9%. Okay. The funds from operations are down about 9.9%. Book value per share is down about 16%. Okay. The stock is down 75%.
Is it down that much? Wow.
Yes. It's trading. It's trading at great financial crisis levels.
Wow.
Okay. So it's trading like it's BK, but you go to investor relations and go look at their property portfolio, and you tell me, even if half the country never steps into an office again, I can guarantee you the buildings that they own, the greatest buildings in the greatest city in the world, are always going to find some demand, even if the rents go down a little bit, because rather than only Housing, Greenhill Investment Bank, and Evercore ISI, and Bernstein, maybe they've got to go down a tier, and the groups like Stiefel, who would never be on Fifth Avenue, now can get into Fifth Avenue. Whatever it happens to be, the fact of the matter is, those buildings are always going to be top bid. Those are the beachfront property for office. And I think the example, and you probably lived through this, you remember 4 or 5 years ago, there was a very similar situation with malls. And people were saying, they had all these pictures of all these malls that were deteriorating around the country. And you had A class, you had B class, and you had C class. Here's the thing. Just like commercial property, I think all the bears are probably correct in that in the time of the mall debacle, most of those B and C properties did get wiped out, and they are abandoned, and those REITs no longer exist. However, the best of the best, which Simon Property manages, that have Apple, that have Lululemon, that have all the top tier stores, they're doing better than ever, and they've done perfectly fine through this situation, and even managed through COVID when all the stores were closed. So it tells you the quality of the business that they owned. And I think the same is true with commercial real estate. I tend to be more constructive on the idea that a greater percentage of people will go back to the office than they think, or than the market thinks right now. And that's particularly because this tight labor market is loosening, and is loosening pretty aggressively. And I've talked to a few CEOs over the last few weeks, a couple public company, a couple private company that have laid off between 10 and 20% of their sales force. And off the record, in all of those cases, it's always the work from home people they cut, because it's a piece of cake. They're not part of the team. They're not in the collaboration mode, and they can never explicitly disclose that, but those are the easy cuts for them, and those are the ones that they're taking first. And people are sniffing this out. And I think if they start to get worried about losing their job, they're all going to rush into the office to get face time and reintegrate in the group, and the collaboration and the spontaneity and all the good things that come from that.
What do you think happens over the next few years? Let's say a company is in New York City and they have 10 floors in a building, and some people are still working from home. They've done some layoffs. Do you think they stay in the building and just give up a couple floors when they?
Yeah, I think that is the thesis, and our thesis is predicated upon if you're taking less space, you're probably going to want to be in the better buildings with what you have left. So it's like, you don't want to
instead of 8 floors in the B building, let's take 5 floors in the A building.
Exactly. Yeah. If we can do that, because it'll be closer to Grand Central, more people will want to come in. You got to consider B and C's are probably further away from public transport. So they've got to get off the subway, take a cab, or get off their trains, take a subway, take an Uber, take a cab. Whereas the A properties are like right next to Grand Central. They can walk to the building. It's a gorgeous building. They're actually going to want to come to work because it's a really exciting place. It's not some kind of dumpy, dingy thing.
And when you have, when you're bringing clients into the office, there's a big difference between bringing a client to an A building and bringing a client to a B or C building.
No question about it. And that's kind of our thesis there. So we don't think the bearishness around commercial real estate is entirely wrong. I think it might be overblown. Like, I think you could probably get away with an SL Green that has some B and C exposure, but we don't take those bets. So for instance, Alibaba, it's like, yeah, we love the company on a granular basis, but it's really our emerging markets bet. And our emerging markets bet is basically our weak dollar bet. So we're looking for ways to benefit from the dislocation, short-term dislocation in emerging markets. So how are we going to do that? We're not going to go into China and buy some small and mid-cap company and flip a coin that it's not an accounting fraud. Our view is that if even when the government was being unreasonable last year, our view was that it was mutually assured destruction. If they destroyed Alibaba, they were going to destroy the Communist Party. You can't make that bet with a Chinese car maker or a Chinese delivery service or something smaller. But you can make that bet with Alibaba. As goes Alibaba, so goes China, so goes the country, so goes, et cetera. It would be the equivalent of the US government shutting down Boeing. I mean, it's just a completely bad idea from a self-interested point of view.
What's going on with Ant Financial? Because that was supposed to be a big IPO a couple of years ago. Will that still go public at some point, or they? It looks,
yeah. So number one, they put the former lady who ran the Hong Kong exchange on the board, like 3 or 4 months ago. Then Jack Ma.
This all sort of stemmed from Jack Ma pissing off the CCP, right?
Exactly. But now he's back in good graces because he came back into the country. The Chinese government realized they went over the edge. They had to reinstill confidence. Jack Ma comes back. The country announces Alibaba announces the split, which is a nod from the government. And then as far as Ant Financial goes, he gave up the voting control. So historically, there's a rule that they have to wait 12 months to IPO after a change of control. Maybe there will be some exception for that. I'd rather let them run it the way it's running for the next 12 months and let the economy just crank so that when they IPO, the numbers are big. And we won't see 300 billion valuation, but if we see 150 out of the gate, then as the business grows and improves, then we can start to get higher multiples, and as capital floods back into the emerging markets, et cetera, et cetera. I don't know if you've seen some of the JP Morgan notes where they have US versus ex-US equity cycles and the outperformance, and you see the tables, but you basically see US equity outperformance like kind of peaking and every 5 to 8 years, and then ex-US, which is basically emerging markets, and Europe start to outperform. And I think we're at that stage. The table is set correctly with the dollar starting to come off the boil as of October. If you overlay the US dollar with emerging markets for the last 20, 30 years, you'll see dollar goes down, emerging markets go up. China is the biggest weight in emerging markets, like 37, 38%. And then Alibaba is one of the biggest weights within China. So if you believe the dollar will remain subdued or even go lower, and you want exposure, our view was that Alibaba was the best leverage way to play it. And now you've got the reopening and you've got all that stuff behind it.
If you wanted to add additional exposure to international emerging markets, would you pick more individual names or just buy the ETFs?
Great question. Probably, yeah. I mean, I would consider buying Tencent, but that's a little bit too much.
I was going to ask you about Tencent if you've looked at it. I haven't looked at it recently. So.
It's a little too much overlap for me with Alibaba, and I don't know if you play poker, but I like a lot of outs, and I like the 6 parts, and I like the optionality with Alibaba relative to the current value ascribed to each of those 6 parts.
I mean, you always hear the term, it's worth the sum of the parts is worth more than the whole.
Yeah.
And we've never seen more sum of the parts than we're about to see with Baba. So
yeah, no question. So I think you could get away with doing like just buying an emerging markets ETF, which is basically buying an overweight to China. We're starting to look a little bit at some individual companies in Brazil, but we haven't done anything in size yet. We don't have that level of confidence with Lula in office. But that's probably the next place that we look. India's already kind of had a run into this because they didn't have as severe of lockdown restrictions as China did. So, I hate to say it, it's the ugliest, but it has the most potential upside is high quality businesses in China, but it's got to be big companies. I wouldn't be playing in mid caps, small caps, no matter how exciting the story, no matter how beautiful the numbers look. I would just go with the bellwether because it's marked down enough. It's going to trade like a small cap would in a normalized environment once things start to go.
Right. No, I agree with you. I agree. What else do you like in the US? What are a couple other names that you can talk to us about real quick?
Yeah. So we talked about Bank of America. We talked about, okay, so here's an ugly one. There's a common theme here. 3M, it's a train wreck because it's got the litigation overhang of the forever chemicals and the earplugs that were used in battle. You saw the Department of Defense come out and say that the people, the sample of people who used the earplugs that were attributed people getting deafness or hearing impairments. There was no meaningful difference between a normal sample of people who didn't use the earplugs. So that bodes well for a constructive outcome on that. And then the forever chemicals, this has been a problem for a while. If you look at the worst case scenarios, you have ridiculous analysts saying it's $100 billion of exposure. You have reasonable analysts saying it's $10 or $14 billion of exposure. The key thing is, if I look at the worst case reasonable scenario, which would be $30 billion, it sounds like, wow, this isn't that huge of a company. That's a lot of money, but it's not paid all at once, number one. So if you consider over a decade, and the stock is down, some 50% plus off of its highs with this litigation overhang. This is a unique business, Jonah, in that this business has been compounding capital, return on invested capital, double digits and in the 20s for years and years and years. This is a high quality business with a moat. The overhang,
3M, are they Post-it notes?
Post-it notes, safety stuff. If you go into the hospitals, they have equipment. They have technology. They have it's a industrial conglomerate. Okay, but yes, Post-it notes is what they're known for on the retail side. But the amount of stuff that they supply, safety stuff to all different industries, is just staggering. So this has been a long-term compounder. Okay, so the point is, if you got a worst case outcome with the Forever Chemicals, which won't happen tomorrow, but let's say they settled at $30 billion, which I think it's going to be a lot lower, but let's just say
that's a huge number. Has there ever been a judgment or settlement that big in history?
Yeah, I think there have, but
like Exxon Valdez, I don't know what that was.
Yeah, well, inflation adjusted and everything else is a different story. But what people are neglecting is the amount of free cash flow this business already generates. So I just backed out. I think right now the yield is, I don't know, 4 or 5% or something on the dividend. That dividend payment every year is over $3 billion a year. So if they paid out that settlement at, over a decade, it's basically saying you're going to have no dividend for a decade. But it doesn't impair the business's ability to compound capital in mid to high teens, if not 20s, like they have for the past 10 years. So the only question in the litigation, from my standpoint, is do I own this business that compounds capital at 20% a year with a dividend or without a dividend? Because the underlying business is still going to grow. So, the way that I look at it is, it'll get resolved. It'll get resolved and I'll keep the dividend. It will get resolved and I won't have the dividend, but the business will continue to compound. And at current multiples, relative to the growth of the business and the moat of the business, I have such a large margin of safety. It makes no difference if I have a dividend or I don't. I'd prefer the dividend because that'll bring in that type of investor, et cetera, and institutional support. But people are kind of operating like if they get this settlement and it's a worst case scenario, they're going to be out of business. And it's just it couldn't be further from the truth. It's like lunch money for them.
So that's what I said when Meta got down to, I forget where it got down to after Q3 earnings, but I mean, the stock was down 75% from the highs, if not more. I said they should just pay, announce a 1% dividend. It would have cost them a few $1 billion a year. But like you said, it brings in this enormous group of investors and funds and ETFs that can only own stocks that pay dividends. And I felt like that, bringing in that group of investors would have outweighed the cost of paying the dividend, but they didn't do it. So have you looked at Expedia?
Expedia is very interesting. We have looked at it for the website. We were talking about the trade service. Long-term, as a long-term major investment, we're not there yet, but I think as a trade, it's going to work. I kind of like it right here. I think
I just started a position last week.
Yeah.
It's basically flat on the year. So it's lagged booking and Airbnb. Stock's down like 55 or 60% from the all-time high. And it's trading with a free cash flow yield above 10%.
Yeah. I know. I see all those things. It's basically, you get the most competitive travel business, which I think there's still a lot of runway for the travel business. And oh, by the way, you get a free mini Airbnb on top of it. I mean, like there's not a whole lot to think about there. I think general market, to put a bow on it, we're kind of constructive. I know there's a lot to be worried about, and that's what the market's doing, is climbing the wall of worry. We spend a lot of time on the Bank of America Global Fund Manager Survey every month, and markets just don't top when managers are overweight cash and bonds. They top when people are overweight equities with leverage.
Everyone's invested, everyone's feeling good, then it's time to get nervous.
Yeah, so there's never a case where the fire comes when everyone's sitting in the theater with an extinguisher in their lap, right? I mean, it's like when no one's prepared. There's never an instance where it's like right now everyone's in T-bills, like, I'll just wait it out. And when the market goes lower, I'll take my cash and buy all the equities and get rich. Like everyone, like your Uber driver is thinking that right now. And when that happens, where's the pain, Jonah? You know, the pain is pushing to new highs and effing, everyone
and all these managers having to try to catch up on performance.
Exactly.
So, I mean, is that sort of that's the melt up, base case? Or if we get a melt up, is that why a melt up in the markets? It's because some of these managers just can't afford to sit on cash any longer. They have to start putting it to work.
Yeah, there's no question. And any bit of good news, maybe McCarthy comes out with a bill that kicks the can down the road for the debt ceiling. I don't know how much of that overhang is in the market. I think there's some of it. Maybe big tech, the guidance is less than apocalyptic. That could be a positive. Maybe there's some type of resolution in Russia, Ukraine. Like, who knows? But no one's talking about anything that can go right. Everything's talking that everything that can go wrong. Yeah, we know earnings are weak. You didn't need to be a rocket science to know that the market was discounting that last year with a peak to trough decline of 27%. Obviously, earnings are going to be soft. The market discounts that 6 to 12 months ahead. And if you look at 2024, you're at 246, and everyone says, oh, that's ridiculous. It won't be 246. So it's 238. But even so, no one's starting to discount that recovery. And here we are going into May. Markets are going to start to look to that, May, June, they're going to start to look to 2024. And as a matter of fact, since earnings season, I saw some stuff out. I think it was Ned Davis, or maybe it was Yardeni, that estimate revisions were actually modestly up since the beginning of earnings season looking out. So we'll see if there's some of these green shoots, but I can assure you, based on cash levels and positioning, no one is looking for green shoots. And if they come, watch out. That's when people get forced into the market, and they won't get forced in at 4,100 or 4,200, wherever we're trading this minute. They're going to get forced in at 44, 45, 46. And you miss that 15, 20%, and many of them have already missed the 17% off the October lows. You can't make that back.
Right. Agreed.
Yeah.
Well, thank you so much. Real quick, talk to us about hedgefundtips.com. You also run that?
Yeah, so hedgefundtips.com is a blog we run. We also do a weekly podcast, VideoCast, which has a lot of hedge fund managers, institutional managers, ultra high net worth, and regular traders and investors listen in weekly. That's free of charge. You should go to hedgefundtips.com, put your email in. You'll get a daily update of the things that we're reading on a daily basis, the research. And then, of course, that Thursday, we do the Thursday research note in the morning you'll get, and then the podcast, VideoCast in the evening once a week. And people have found that really valuable. We're on like episode 184. So we've been going,
Awesome.
3+ years, and people seem to like it quite a bit.
Real quick.
As a matter of fact, in the hedge fund category, if you go to FeedSpot, it's ranked #1 in the hedge fund category.
Oh, nice.
So small niche, but people like it.
So what's your favorite thing about running a hedge fund, and your least favorite thing?
It's like people ask me, what would you do if you weren't working? I would do exactly what I'm doing right now. I love it. I'm sure you experience it. You either love markets and you love, I feel like I'm on a treasure hunt every day. Kind of the Buffett to skip to work every day. I'm just looking for high quality assets, compounders that are temporarily impaired, either due to sector or market general dislocation, and then understand the bearish thesis before I put on a bullish position on, and then I'll look at the other bullish theses. So I'm not looking for confirmation bias. And then just wait for a normal reversion of a high quality business. And we covered a few of them today, and there'll be more to come. But that's what we do. So I would say that's probably the best part of being in the money management business. And I will say the worst part that most people don't like dealing with clients, but I've been blessed to attract the right clients. And candidly, I've attracted them through one, word of mouth, through satisfied clients, but number two, other people that just listen to the podcast for 6 to 12 to 18 months. I've had one guy came in last month who's been listening for 3 years, and they finally come across, but they already know the mindset, and they see how you have managed through different periods and different cycles in the market. So they're on board, and they're of a similar mindset, because the fact of the matter is, we have a high minimum. So it's very ultra high net worth people, but they have all made their money with the same exact mindset, even if they're not in money management, even if they're in real estate and they bought high quality assets when they were temporarily out of favor. If they're rolling up companies, they did the exact same thing. So they get the mindset, and that's why they're already wealthy. And they're
willing to be patient, right? If you have a bad month or a bad quarter, they realize it's a marathon, not a sprint.
Yeah, and they know what they own, because I've got, I give full disclosure. I explain the theses. I explain why we own it. I explain what's changed, what hasn't changed, and they're on board, and they know we're buying high quality stuff. So it just works over time, and it's great. And it's what's beautiful is I track the type of people that number one become friends that I'd want to hang out with anyway. So I really enjoy it.
Awesome.
I've just been blessed in that regard.
Glad to hear it. Well, thank you so much for joining me today. Really appreciate it. I assume you're in New York, right?
Yeah, today I'm in New York, and we also have a place in Connecticut. So it's kind of, we like it down here.
Awesome. Well, great to finally catch up with you, Tom, and look forward to talking with you again someday.
Thanks again, Jonah.
Talk to you soon. Bye.
And we're back. So that's pretty much the overview for this week as far as positions, as far as positioning, and we're seeing it right now. We talked about the wall of worry pushing through today after tech earnings beat expectations, which we anticipated on the public podcast. So we're going to go through now our normal information, but I wanted to start with the commitments of traders, because I'd referenced that actually I was on another podcast today, which we'll publish next week in the VideoCast with David Lynn, who was formerly with Kitco. Now he has his own show, does a great job. But here's the US dollar. And Stanley Druckenmiller was out today or yesterday in the FT saying that one of the positions, actually here it is right here, that he feels most comfortable with is shorting the dollar. He's 13% late, but at least he's in. And he said, currency trends tend to run for 2 to 3 years. We have had a long run higher, and now he thinks that this is going to continue for the next couple of years, weakening, which is in line with our view in fits and starts. We could get a short-term counter-trend bounce, but it's nice to see that because, he kind of made his name with Soros shorting the pound. So he has a lot of credibility when it comes to currencies, and it's nice to be on the right side, same side of the trade with Druckenmiller, because that's going to drive our whole emerging markets and Alibaba trade as that persists. So I just wanted to show you here, because usually I look for commercials. So they get short ahead, and then you get weakness in the dollar. They get short ahead, you get weakness in the dollar. And then conversely, the red line, which is the hedge funds and speculators, they get long after it's too late. They get long after it's too late. They get long after it's too late. Commercials have started getting long, but if you look historically here, you'll see that rarely do you get a trend reversal until they get above the zero line into positivity. And some of the biggest drops are right in that last move here where you get the collapse in the dollar. So I think, we're at negative 16,000 contracts. When we get to a positive number is when I'd start to lighten up on any dollar shorts. But we've got room, and this should be the sweet spot in coming months moving forward with the dollar, which is a trade. Moving on, I want to do a couple of commitments of traders here. Let's see if we can get through the indices if it doesn't take us too long. Bitcoin could care less. All right. Let's see. Euro. Okay. Euro. The commercials are getting short, but it could have some room to run, and it can persist too. When you get, as Druckenmiller was referenced, yeah, they got short here, but as they kept getting short, it took multi-years, as he referenced, and that was the rally. So less of a useful indicator with that instrument. Here, Australian dollar, they've been getting long. This move is just starting. So we've covered a lot of these. I'm just trying to recognize the contracts here so I can get to some of the indices. Probably the faster way to do it is to just go here, because we're going there. And so if you look at the Dow, the S&P, the Russell, the NASDAQ, what you're going to see, and I just love this today. I love the offsides here. We've been talking about it and pounding the table. Wall of worry, the pain trade is up, and sure enough, all these cash and T-bill people are getting their faces ripped off today. But you could see this coming. Okay, look at commercials, how aggressively long they've been getting for months and months and months. Same thing right after the pandemic, and it just climbed that wall of worry. Same thing after the 2018 crash. So this was pretty obvious. It feels like it's been forever because the market's made no progress in 2 years. But the smart money was getting positioned for this, while the dumb money was going against it and being record short S&P contracts going into this. And now they're absolutely getting face ripper here. So that's all you wanted to cover on that front. Here's small caps. These we've talked about. I said that the way to play the bank thing is not through regional banks. The way to play it is buy small caps. You'll pick up any recovery in the banks, but you won't be at the effect of it. And if you look at relative valuations, there's going to be an opportunity. We're playing this obviously through Cooper Standard. Is a monster position for us, and that's been nice, and it's going to continue to work as we saw with GM earnings, and we've got them reporting next week, which is exciting, and the volumes and the car inventories and the dealer lots and all the exciting things that are happening under the surface, which are getting drowned out by a bunch of short-term nonsense. But that's what creates the opportunity. So you don't be angry, be excited that the market is inefficient. If the market was perfectly efficient, there would be no reason for us. So here we go. So this is an area we want to start to pay more and more attention to because they haven't been this cheap since the great financial crisis lows, and we want to pay attention to that. So we have our emerging markets and dollar exposure through Alibaba. We have our small cap exposure through Cooper Standard, and we've talked about some of the other positions with Jonah. Now, some headlines. Where are markets and the economy headed? Barron's poll finds a lot of uncertainty among big money managers. Uncertainty equals negative, equals cash, equals bonds. And like I always say, markets never top when everyone's overweight bonds and cash. They top when people are overweight stocks and overweight stocks on leverage, and we're nowhere near that. Larry Summers rejects the de-dollarization hype. Larry must have watched my CNBC Indonesia interview. No, I'm joking, but it's good to see that. Hedge funds place biggest ever short on benchmark treasuries. So why are they betting record bet against treasuries? They think yields are going up. They think the Fed is going to hike more than next week and hike again. And I think that's going to be the wrong bet. And we're going to cover that in the article of the week, why I think that. But just leaving aside all the fundamentals we're going to cover, just seeing the position, maximum pain is that bonds rally, yields compress, which would imply the end of the tightening cycle, which would work for every single position in our portfolio, particularly emerging markets, BABA, dollar, and multinationals that have exposure, which is our entire book. So this is setting up for another massive squeeze on these people that are all crowded, hedge funds crowded all into short bonds. And that would be the surprise, and that would force markets up higher, which would force all that cash in a chase and at the exact wrong time, which we've been predicting since the October lows. So here we go, next leg higher. Credit Suisse, this is from Seth Golden. Number one key to the market's advance, earnings momentum. Well, while everyone's talking about the world is ending, look what's happened. Same thing that happened at the pandemic lows, same thing that happened at the 2015 and 16 lows, which is EPS momentum breadth versus the S&P return. And that has done a complete about face. And this is from Credit Suisse, improving since January and December 2020 among three sectors. Three are in the process of bottoming: energy, financials, and REITs. Energy, I think there's stuff to do in energy now. I mean, there's like the big ones have run too much. There's not the huge risk reward that I love, but in terms of, and I've said it over and over, the companies, the natural gas companies like Comstock, like Range, albeit we own it from much lower levels, and and I don't like to buy up, but I wouldn't oppose doing a new position in those type of names at this stage. Financials bottoming. We already got Bank of America in the hole last month when everyone was puking it out. And REITs, Vornado, we'll talk about that today, which is exciting. So while 7 of the 8 are on an upswing from depressed levels, so there's that from Seth. Why the banking mess isn't over, deposit flight and higher funding costs risk squeezing small businesses beyond big cities. The Fed needs to wake the hell up and do their little pause, get to their terminal rate next week of 5.10 and call it a day. Just say we're going to keep rates elevated. We reserve the right to hike again if inflation doesn't cool on a lagged basis, but we're done and declare victory. And then a lot of these problems will start to go away. But the fact that you have no end in sight is why these banks are going to continue to break. Commercial real estate is going to continue to price in the end of the world, particularly in B and C properties. And when that's over, all of that unwinds. Same thing with the emerging markets. Same thing with biotech, by the way. These things are all correlated. Like the minute the Fed is done, you're going to see REITs get bid. You're going to see emerging markets get bid. Alibaba's going to get bid like crazy. You're going to see biotech get bid through the roof. It's also been in that same sideways consolidation, high correlation to BABA. It's all going to be overnight, okay, once they're done. So let's hope it's next week. If they're smart, if they're dumb, it'll be another month. But I think that barring a forced marriage, someone taking over First Republic this weekend, or First Republic going into receivership this weekend, they're probably going to pause because that overhang is still there. That uncertainty is still there. Obviously, we need a decent core inflation print tomorrow to give them further cover. But if we get that, then I think things bode well. And I think everything flips all at once, and it'll be well worth it here and very, very exciting. So that's the story there. This is SL Green, which is A, properties in New York City, but more B and C. But even he was out this week very, very optimistic. He said Holiday wasn't convinced by the doom and gloom perception of the office leasing market, anxieties that he blamed on media coverage, and said there are positive indicators despite interest rates sending a chill through the real estate debt markets. New York City always finds a way to remain a global capital, attracting the talent that leading and growing companies need in times of change. There are a number of positive indicators and developing trends that give us reason for pragmatic optimism, though clearly a challenging environment. Some indicators mentioned by Holiday were ridership on the Metro North Railroad reaching 74% and 74% of the pre-pandemic average from April 9th through April 15th of this year, by the way. And Long Island Railroad trains seeing an average of 170,000 daily riders. Holiday also believes the real estate industry will see a boost as New York City's crime rate declines. He also doubted the full-service opening Grand Central Madison, which brings Long Island Railroad riders from Queens and Long Island, just a block from one of SL Green's newest towers, okay, which, Vornado has all the Park, Madison, 6th, 5th, and also Penn Station, the redevelopment. So all of these, as good as they are for SL Green, are even better for Vornado. And then, what else does he talk about? He signed 41 leases totaling 500,000 square feet in the first quarter. There was an increase in the number of deals compared to the first quarter of 2022. So, and that was a beat, as well as Boston Properties. So I think that everything here is pointing in the right direction. We also saw Boston Properties beat on top and bottom line. MasterCard beat shows households are spending more on travel with stock rides. That should bode well for PayPal. General Motors raises 2023 guidance as first quarter earnings beat expectations. Corporate insiders step up stock buying after banking turmoil. Particularly, they're buying in the financial sector, so that bodes pretty well. And that's usually good for the general market. Why is insider buying important? Because insiders sell for a multitude of reasons, whether it's a normal plan, a pre-planned selling program, or they have life events, etc. But they only buy for one reason, and that's because they expect the stock to go up over time. And they're not looking for a trade in a quarter because they can't sell in and out of the stocks because they have to publicly report and they don't want to send conflicting messages to the market. Okay, next thing, going on to China here. Alibaba's cloud computing services subsidiary entered into a pact to collaborate with state-run data exchange in Shenzhen, China's southern tech hub, in a move that is expected to bolster how companies buy and sell data in line with the country's digital economy plans. This is a nod from the government working with the state-owned enterprise that Alibaba is now okay, and this is a big thing that was overlooked in the media. But the climate has completely changed, and we're going to talk through some more data besides this this deal that they did with the state-owned enterprise. Also, China to scrap PCR tests for inbound travelers and latest easing. Here's an article, Nothing Would Save Forgiveness Like an Ant Group IPO. And this talks about kind of the IPO track moving forward. And it also breaks down the now 6 parts of Alibaba business. So Taobao and Tmall is 29% of the business. Global digital commerce is 8%. Local services 8%. Logistics 7%. Cloud 14%. Digital media and entertainment 7%. And cash is 26%. So, I thought it was telling that a piece of their business which investors really assign no value to, for Shippo, which could be the next Costco of China, the supermarket business with membership fee, is IPOing for $10 billion. The logistics business is supposedly IPOing for $20 billion. Ant Financial will IPO. Usually it's 12 months after a change of control, which happened with Jack Ma, I think late last year or early this year. So that could be within 12 months. So all of this value is going to get unlocked. But the key is the underlying business. And the point that I make is often that people have been extrapolating the flat performance of the last 2 years while the country was locked down out into the future in perpetuity. And the play is a reversion to pre-trend, pre-once-in-a-100-year event. And I actually think with the pent-up demand, with the stimulus, with everything else happening, and now the government's interest, just as they were interested before the election or the appointment to slow them down, now they're incentivized to speed them up after the riots. And the protests, rather. So a couple of things that I want to point to in Q1, because they report in a handful of weeks. I couldn't find an English version of this article, but my Chinese friend sent it to me, saying that VIP shops saw clothing segment sales increase by 40% year on year during the March 8th festival in China. That's Q1. Alibaba's gross merchandise value is 53% clothing. So this is a big deal, the read through from VIP Shop up 40% year on year, with Baba's GMV being 53% clothing. You can also go to VIP Shop's annual report to see how much their GMV shrunk over the last couple of years as they were clothing heavy. So we're going to see that was already priced in. No one's expecting upside, and it's such a huge percentage of their business that very little growth value is assigned to their e-commerce, and I think that it could just be getting started, and no one is positioned for that. So pretty exciting on that front. The other thing is Pinduoduo is mainly agriculture products, JD is electronics, and Taobao Tmall is for clothing. If you ask any average Chinese consumers, they will tell you this. So when people think about clothing, they think about Alibaba, Taobao, and Tmall. 53% of that is clothing, and that went through the roof. Why? Because when you're locked in your apartment, literally and figuratively, you don't need clothes. It's when you start going out. So all the pent-up demand for 3 years we're going to see in Q1's reports, which is 50% of their e-commerce business, and Q2 and Q3 and Q4 moving forward. It's going to be a new regime of unexpected growth, and that's the look through from this. Now, We still need the Fed to back off. We still need the dollar to go down. We still need all that. But the good news is we won't lose, once all those things fall into place, we won't lose the benefit of the underlying business having improved before conditions were right for the stock to improve. So we'll get it all retroactively at the same time. And it's kind of like building a house, okay? You know, for months and months and months, you see nothing, but under the surface, they're building the foundation. But from street view, it looks like they've made absolutely no progress. And then, so that could go on for 12 months. It could go on for 18 months as they build the foundation. They put in, you know, the boiler, the heater, all that stuff. And then a week later, there was nothing there. And all of a sudden, 2 stories are up, because once the foundation is laid, the thing can rise overnight. And that's why we're talking 160, 180 for that initial move, fill the gap, and the other factors that we talked about of recent weeks. I think it's going to be quick. When it goes, it's going to go fast, and it's not going to let anyone in. So next thing is okay. So one thing no one else seems to talk about is gross merchandise value makeup between Baba, JD, Pinduoduo. Over 50% of Baba's GMV is clothing and beauty products. And you remember last week we covered the retail sales crushed expectations, GDP crushed expectations, and a huge percentage of that was cosmetics. So not only are they going to hit it on the cylinder of 53% being apparel, they're also going to hit it on cosmetics, because when people go out, they want to look good. So that's why you saw some strength in PDD, Pinduoduo relative to Baba. That equation is going to change very quickly. However, the newest Q1 data, 2023, is showing 17% year-on-year growth for clothing. VipShop, another clothing heavy e-commerce competitor, reported seeing as high as 40% year-on-year growth in their women clothing sales this year. People saw the Baba numbers going down and modeled out to the future as if it's stagnant. But if you look deeper as to what is driving the growth, you'll see much better into the future. If we see Q1 Baba China commerce grows 10% year on year, what do you think the market will do? Obviously. Okay, so that's the story there. Moving along to daily active users here. The average of, the King's Return. So Taobao daily active users overtakes Pinduoduo. This is from yesterday. According to late financial reports, third-party data shows that in March this year, an average of 377.9 million people used their mobile phones to browse Taobao every day. 26.3 million more than those who use Pinduoduo. Remember, Pinduoduo was the agriculture. They did better during the lockdown. Now the game's back on, and Alibaba's back in pole position. This is the first time since February 2022 that Taobao's monthly average daily active users have surpassed Pinduoduo. Again, regime change. Data also shows Pinduoduo's DAU fell 9% month on month, while Taobao's rose by 2.4% month on month, et cetera, et cetera, et cetera. So you can go through that on your own. And then finally, this data here is from Heel & Home, just reported their Q1 earnings yesterday. They are the largest enterprise among the garment sector in China. Screenshot shows the online sales grew 17.7% from 537 million to 632 million in Q1 2023. Last year, this number was down 6.5% Q1. So there you go. This is all pointing to great things for Q1 for Alibaba, Taobao, Tmall, and that's before you even get into the other businesses. So we're pretty excited to see that. And thanks to Jack Zhang for sending over some of that information. Very excited. Article of the week, put it out of its misery, stock market and sentiment results. You should take it behind the barn and shoot it. What are we referring to? First Republic Bank, earnings are coming in nicely, but there's an overhang on the market And until resolved, the market is stuck in the mud. First Republic is now a zombie bank, and no one wants to take it over because they'd need to raise a significant amount of equity capital against the upside down assets and write-downs. The bank is sitting in a fetal position waiting to die, and no one will pull the trigger. In the meantime, the market suffers waiting for the inevitable despite better than feared earnings across the board. Management deciding not to take any questions on their earnings call after losing $102 billion of deposits gave a dose of courage to the short sellers who felt like masters of the universe after that spectacle and pushed the stock as close to zero as the market would bear. The Fed had to increase the balance sheet once again last month as a result of the mini crisis. You can see there, while it has cooled for now, the resurgence of First Republic fears may cause the Fed to think twice at their meeting next week as to how hawkish they want to be. This is particularly true if there's not a forced marriage or receivership for FRC over the weekend. So while this does not look like a pause next week, 72% odds of a hike, these three factors could skew the odds to a surprise pause or a raise in pause. Number one is the FRC. We still have 45% of deposits not insured in the United States. And if you remember, since the beginning, I kept saying this is not over. We're not buying regional banks. We'll buy the ones that are too big to fail. And we bought Bank of America until they backstop the deposits. So this will continue until they fix that, which is positive in the sense that it may force the Fed to get out of the way sooner than later, particularly because we now have some dovish people with sensible minds like Austin Goolsbee and others starting to tilt dovish, and some of the data starting to tilt dovish. Historic pace of bank deposit outflows, so that continues, and that's going to continue until the government steps in and does the right thing on that front. You're seeing it all move into money markets, and I covered it on the podcast I did today with David Lynn, which will be out tonight and we'll cover in next week's podcast. And then finally, I thought this was an interesting chart from two standpoints. Number one, credit conditions are tightening, so that should scare the Fed a little bit. But more than that, we've covered this very often with OIS spreads, high yield spreads. This is a different way of looking at this. Is the U.S. speculative grade default rate. And what this person is doing is extrapolating that what's happened in the recency bias is going to happen again. And we take the other side of that trade. If you remember, we've always talked about you get the initial heart attack, which we had in 2000, and then you get these aftershocks while you have multi-year equity market runs. And we believe this is just another aftershock in the short term, and we're in the middle of a multi-year equity run that's going to persist and take everyone off guard with everyone in cash and bonds. Look, when everyone gets overweight stocks and stocks on margin and the skew goes up and people start making insurance bets on 2 standard deviation out moves, we'll get more cautious. But we're nowhere near any of those levels. In fact, we're at the exact opposite. We're at those levels of petrification. You know, people are literally petrified based on how they're positioned. And the market is never going to give you an opportunity. You know, right now, you not only can see it with institutions. Go ask your Uber driver. I guarantee you they're going to say, well, I'm sitting in T-bills collecting 5% until the market goes back to its lows and I'll buy equities on sale. If everyone has the same, if everyone's thinking the same thing, someone's not thinking. And I can assure you that same Uber driver will be forced back into the market at 46, 47, 4,800 or new highs. And just as that final marginal dollar goes in when everyone's overweight equities is when we'll get a 10, 15% correction back to 4,500 and knock the stuffing out of the Johnny-come-latelys who thought they had it right. Here is GDP we saw today, 1.1%. That's another reason for the Fed to chillax. 3 is the core PCE, which we see tomorrow. If this comes down, that might be the final thing they need to just lay low and, maybe a hike and a pause and do very dovish talk next week, which would set this thing back afire, which would be a very good thing. Wow, look what's happening today. This is a very exciting day. All right. Back in the real world, here's what's happening with earnings. Just everything's beating. That's all you need to know. Green, 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 green. Everything that matters is, Meta, Alphabet, Microsoft, tech better than expected, General Motors, even 3M reported better than expected. They're doing the job cuts. They're doing the restructuring. So that one's going to be just fine. Visa, top expectations. That should read through to PayPal. Big banks reported strong results. So all of this is in place. We covered that. We went through the in studio with Liz last week, which was phenomenal. Thanks to Catherine Myers, and Jake Mack and Liz for having me on. And now let's go to the Alibaba update. So while the stock price has done nothing for just about a year, you can see it here. Perfectly symmetric, by the way. If you believe in fractals, this would imply that the next move should look something like this move, right? So if you take like a reverse butterfly type of thing, we don't put a lot of credence in this, but it's uncanny. And we've talked about the inverse head and shoulders with up to 160, fill the gap to 180, et cetera, et cetera, et cetera. So while the price has done nothing, the fundamentals and environment are improving dramatically. As volatile as Alibaba has seen for the past year, it's not much different than the S&P as a whole, which has not only done nothing for the past year. By the way, these charts look exactly the same. Inverse head and shoulders, pain trade up. It has done nothing for the past 2 years, the S&P 500, with a lot of volatility in between. Same upside volatility as downside volatility, but no net progress. And here are the last few hiccups I was asked about by followers on Twitter and friends via email this week, along with my responses. Just the kind of headlines you need to take the final, quote, weak sisters out to the woodshed before the takeoff. So here's a guy named Money Flow Research. As Baba shareholder, very concerning, this letter has asked the Biden administration officials to add Alibaba Cloud to the Commerce Department's export control list, arguing its close ties to China military renders a clear ongoing national security threat. Hedge fund tips. Thoughts? Question mark. I said, Ali Cloud is not used in the US anyway. It's like banning Twitter in China. No one uses it there. Understood, but this is also in the article. Quote, we urge you to use all available tools to engage in decisive action against these firms through sanctions, export restrictions, and investment bans. My reply, same story every month. Happy to own the stock in the UK. Happy to own the stock in Hong Kong or the United States. Makes no difference to me. So if they ban ownership here, I'll own it there, and vice versa. It makes no difference. Finally, if you look here at the traffic, U.S. traffic is less than 1%. But what is key that came out of this, okay, we'll get to it again here, is the growth in Aliyun, which is Ali Cloud, in the last 3 months is off the charts. Last month alone, up 89.9% with 46.7 million visits. No one is looking at this. So when you couple this with the clothing thesis and some of the data that Jack shared, I think we're going to have a blowout quarter. Let's hope the Fed is done at that point so we can not only have the blowout quarter, but actually benefit in stock price from the blowout quarter. And that could be a convergence of everything all at once. Here is Aliyun's Ali Cloud U.S. traffic. My guess is the traffic is mostly comprised of U.S. senators and their aides looking to ban it, as no one uses Ali Cloud commercially in the U.S. So here it is. China's 90%. U.S. is 78 basis points. This third response is most important, as I referenced it to a friend via an email this yesterday. His question was, quote, I know you're also very bullish on Ali Cloud. What do you make of the headlines today that Alibaba is cutting the cost of its cloud service between 15 to 50% to win users? Do you think demand is slowing, competition is heating up, or the government told them to do so? Either way, probably not positive for margins, question mark. My answer, 2 items on Aliyun. Number 1, Chinese traffic for Aliyun in the last 3 months since the reopening is off the charts. You can see it here, from 20 million visitors to 46 million visitors in 3 months. Okay, talk about a reopening. Up 90% month on month from February to March alone. Couple that with Tencent, which is around half the visitors and much slower growth since the reopening in January. They've only grown 17% in the last month and from 15 to 24 in the last 3 months. Aliyun currently has 36% share and is competing to gain share against Baidu, Tencent, and a few state-owned enterprises. So they're number 1 by a long shot, but they want to keep it that way, and they want to keep pounding their competitors down, just like AWS did when they were in their early growth stage, and just like Tesla is now doing with the electric cars. So this is a razor blade model, like Gillette built a massive franchise on, to basically give away the razor, the handle,
so that you can sell the razor blades in perpetuity. And that's basically what they're doing here because of the high switching costs. Once you have all your data on Allianz or AWS, the last thing you really want to do is switch to Google or switch to Microsoft Azure, or in the case of AliCloud, switch to Tencent or some other thing. You want to stay there. And once you've got them and you control the customer, then you can upgrade. And they're going to make all their money on generative AI and other software upgrades and products. That's once they control the market share. And I think this 36 is going to go to 45 because a lot of their competitors got knocked out during the lockdown. And so what they need to do right now is they need to sweep up all the share that they can at any cost and then turn on the services spigot over time for margin expansion. Amazon followed the same strategy until they reached scale and their margins expanded tremendously. Furthermore, share growth and share gain and growth is of more importance ahead of the IPO valuation than margins. So this piece could be IPO'd. They want to get the biggest possible valuation they can. And when it comes to this business, it's not cash flow that's going to get the big valuation. It's revenue growth and it's share growth that's going to get the highest valuation. Especially considering how early days cloud conversion and digitization is in China. Same game Musk is playing. He's the leader, squeezing the entrants until he owns the space. And it's the same game that Bezos played, which made him the richest man in the world when he said, quote, "Your margin is my opportunity." And Allianz will be no different. They're going to be number one. They are number one. They're going to continue to be number one. They're going to get bigger. And then they're going to have the resources to offer the best services and just turn on the cash flow spigot. And it's just going to be a beast. $10 billion of operating income, which will take the operating income 66% higher than when it was at the peak when the stock was trading at $319. And we're going to be off to the races as the whole climate changes and you get the chase up and you get the FOMO and the despondency turns to euphoria and off to the races. But we're not there yet. And we anticipate that's coming sooner than later. So here's the upgrades in China GDP. If you remember when they came out with 5%, everyone said, nah, that's not going to happen. No way, blah, blah, blah. Here we are 2 months later, and now people are just tripping over themselves to crank up GDP expectations, which is also part of our bullish thesis for the entire world. And now you got JP Morgan at 6.5% or just under 6.5%. Now, Vornado update. We bought a 5% position in Vornado and Bank of America last month to take advantage of the mini banking crisis crash. We laid out our thesis with Jonah in the podcast that you heard before. Last night, Vornado announced they would start a buyback program for their shares of $200 million and postpone the dividend until year end after they calculate asset sales and taxable income. We think this is a sensible and opportunistic plan given the environment and is a more efficient use of capital. Ordinarily, when a REIT cuts the dividend, it is a move of last resort. In this case, they are being aggressive to take advantage of a once-in-a-decade opportunity to buy in shares at a massive discount. They have among the lowest multiples among peers, lower than during the Great Financial Crisis, and the most liquidity of anyone in the group. Let me repeat that. And the most liquidity of anyone in the group. By Bank of America's analysis through 2024 shows Vornado has $1 billion in excess capital, including its line of credit, above upcoming debt maturities and current construction pipeline. Note, the 2024 maturity is non-recourse. Let me say that again. The 2024 maturity is non-recourse. Okay, what does that mean? It means that, so depending on the environment, they can simply turn in the keys to the individual buildings that are secured by that loan that matures in 2024 without impacting the rest of the portfolio. Let me repeat that. They can simply turn the keys into the individual buildings without impacting the rest of the portfolio. The stock is trading as if it is recourse debt and would impact the entire company. It is simply not the case. This is the lender's problem, not the owner. The old joke is, two businessmen were at the bar talking, and they were talking, and they said, I owe the bank $5 million, and his friend says, "Oh my God, how do you sleep at night? You owe the bank $5 million." He goes, I sleep like a baby. It's the bank that should stay up all night. So that's the story here with Vornado. The lenders do not want the properties or the marks on their books, so they will have to be flexible with terms, extensions as loans come due. And like every cycle, we're going to see this as the same regime of extend and pretend this cycle as you do in almost every other downturn cycle. Now, at some point, the Fed will wake up and stop, and this will be a distant memory. The question now, as it has been for months, how much do they have to break before they get the message? So here you can see the multiples on Vornado, lowest than peers. The average is 5.9. They're at 5.2 times current FFO, funds from operations. During the Great Financial Crisis, they were at 10.9. And where's that chart? Oh, that's Allianz. Okay. Here it is. So last month we initiated, it got down to $12.53. The Great Financial Crisis low was $10.59. Today, after the news was announced, and by the way, the best time to buy these stocks is they're always fearing a cut of the dividend, which is probably what 3M is doing right now. And once they actually cut the dividend is when it starts to rally. And while Vornado actually sold off like 13% pre-market, it didn't quite get to the March. It didn't get to the March lows, but or the Great Financial Crisis lows. But now, as we sit here today, I think it's almost back to even. So after they've cut the dividend or postponed it till the end of the year. So basically, the point I'm making is the stock is now de-risked. That which the market was most scared of has happened, but the assets have not changed. The only difference is we will own a greater interest in the top buildings. And by the way, you click on this link, you can see their whole portfolio of buildings: Park Avenue, Madison Avenue, Fifth Avenue, Penn Station. Top buildings in the best city in the world without using any more of our own cash. We're going to own a greater percentage without using any more of our own cash. Although we did use a little bit of our cash in an account that had it available to top up. Plus, we're not going to assume the tax bill of distributions in 2023. It's the best of both worlds. The stock will sell off short term as a knee jerk, maybe even test last month's or Okay, so I wrote this before the opening. Maybe even test last month's or Great Financial Crisis lows, giving management the opportunity to scoop up shares at a bargain price on the owner's our behalf, increasing our percentage of ownership. In management's shoes, I would wait a couple days to wring out all of the small investors who are in the stock to chase yield with no analysis, then buy in the float in size in coming weeks after earnings they report on Monday. By the way, they're not in the market today, so this is actually close to break even on quote unquote bad news. This is just natural buyers in the market because they're in a quiet period. They can't be in the market because they have non-public information coming out on Monday. In the meantime, the underlying assets remain, quote, beachfront, some short-term pain for long-term gain. Boston Properties is the second best position for liquidity as they also deal in Class A office properties. Boston Properties beat earnings this week. Vornado reports on May 1st, so you can see it here. This is talking to occupancy rates, which keep going up. New York jumped 5% last month, by the way. Here's the petrified retail investor. Bullishness is 24.1%. Bearishness is 38.5%. Fear and greed indecisive. And let's see what the National Association of Active Investment Managers printed today. Last week it was 78.76. It's down to 50%. This is exactly it. They puked out earlier this week down to 50%, which is super bearish. And what happens today? The Dow's up 540 points, ripping their face off. Now they got to chase back in. All right, earnings. Materials, top 30 weights. Earnings power in the last 60 days decreased by 19 basis points. For next year, down 1.96. That's why at the end of last year when they were up and everyone was super excited, we're telling you hard pass. And what's everyone down on is the growth stocks. Well, look what's happened in the last 60 days. This is the IBD 50. FFTY is the ETF. These are growth and Momo stocks. Their earnings power, top 30 weights, has increased by 7.95% in the last 30 days. Top 30 weights. 60 days for the top 30 weights for 2023. And for 2024, their earnings have gone up 6%. And everyone is got their head between their legs, kissing their you-know-what goodbye. And in the meantime, all these things are happening under the surface, but no one knows because they don't do the work. So that's why you tune in here, so you have the advantage. Here's earnings still up at 246. People can't figure why estimates aren't coming down. Estimates aren't coming down because we're looking at 2024 and the market's going to be pricing in the recovery, whereas last year it priced in the downturn. Market's a discounting machine. Discounted the slowness we're seeing now 6 to 12 months ago in October and June, discounting the recovery we're going to see in 2024 starting now and over the next few months. So you saw today the GDP came in lower than expected. That's a data point to give the Fed cover to one more and done. Tomorrow is very important to see the core PCE. If that comes down below estimates, plus you've got the GDP, plus you've got all the layoffs, plus, they should be able to say, all right, we hit our terminal rate, let's see how it goes, and we reserve our right to get back in the market. Ask me anything questions. Raza R asks, hello, Tom, great content. What are your thoughts on Match? It's corrected a lot, and it's also a company that owns all the trendiest singles app, Hinge, which is what I see most people using around me here in California. And Morgan Stanley had a segment about how undervalued it is currently. Raza, I agree with you. I think it's cheap. I think IAC is cheap too. I think Barry Diller's the best in that space. And as the Fed finishes up, I think that they're going to start to get rewarded for it. So, I mean, we'll do a quick thing here just to take a look at it. But Match. Okay, so $50. Let me just see. Where is the... All right. Wait, maybe it's here. Yes, it is. Okay, Match. All right. So, wow. It's, yeah, I mean, this thing has gotten slaughtered. It's down from $182 down to $35. And look what it's been doing in terms of business. Forget price. Business, it's growing revenues per share. It's growing cash flow per share. It's growing earnings per share. It's compounding capital at double digits. Okay, it got hit during a little bit post-COVID, but it seems like it's coming back. Yeah, I think this one's a winner. Good work. Obviously, you know, get on the calls, listen to management, all the different, you know, websites they have, understand the trends, look at the competition. But, you know, like I always say, we invest with a crayon, not a scalpel. I mean, you know, if you bought it at 35 and it goes to 20 before it goes back to 100, it's not the end of the world. Let's just take a look here. If I can find any red flags whatsoever. Having a hard time. All right, so the cash from operations has been cut in half since the pandemic started. They've been repurchasing a ton of stock. Jeez. I mean, it's no wonder Barry Diller. I mean, love him or hate him, the guy knows how to make money. And they're generating free cash. I think this is a home run, Raza. I have to do more work on it to make it a material position. It's in our trade service, by the way, but as far as doing a real solid position on it or figuring out what I would sell to replace it with this, but I like, there's nothing, I mean, they've even retained their gross margins more or less. There's nothing to really hate here. I mean, I think this is a win. I would want to see, you know, learn about Hinge and all these other things. I don't know if they own Tinder or not, but just find out what's popular and if it's working, to make sure, because I think Match is for like older people, and so the growth rates might be slower. But if they have some of these popular younger ones, I just think there's enough margin of safety that, anyway, good work. Amchin Ron, what do you think of Berkshire Hathaway? Short it. No, kidding. Never in a million years. Just own it. Thing I don't like about Berkshire is if I'm at this point, it's gotten to the point if I'm going to own Berkshire, it's like owning Apple. And I don't like that, to be honest with you. I would like to own Berkshire X Apple and own Apple by itself if I was going to own Apple. It's become such a huge portion of the portfolio. But yeah, Berkshire is absolutely fine. And Merkel, absolutely fine. I looked at earlier. I think, by the way, the guy who runs Merkel was featured in that William Green, Richer, Wiser, Happier that I really loved. That book, if you haven't read it, read it. But I think there are better ways to make money. Like, these things have already kind of run off the bottom. But if you want to own it as a long-term compounder, like an annuity, have at it. I just think there are things that are more displaced with better entry points where you can get a lot more juice and have doubles or triples over a couple of years versus, make 10, 15% a year and call it a day. But on balance, sounds good. Again, from Ron Amchin. When valuing Alibaba, do you think it's appropriate to exclude the loss-generating segments? Eventually, I would presume they will become profitable or get sold, and then obviously can only trade for a positive value when spun off. No, you don't exclude anything. Analysts seem to use the $15 billion as current income, but the commerce segment alone generates $23 billion. If we had $10 billion from the cloud segment by 2025, we get $33 billion. Correct. $40 billion seems within reach with growth in some areas. Ant Group, which at the current $235 billion market cap suggests a 6 times multiple of 2025 earnings. Do you agree with the approach? Again, crayons versus scalpel. We think Allianz can earn $10 billion. You put a 20 times multiple, which would be low based on the growth rate. That's a $250 billion business. And, you've got, it was going to IPO for 300, so cut it in half. That's 50. Then you got Taobao and Tmall, which no one's really attributing any value to. That's a $250 billion business. And that's how you really get to, a third of intrinsic value at current prices. I think that it could be even more, but we're going to just have to see where we are in time and price 3-4 years out, because I don't want to push it too far from a demographic standpoint, from a cycle standpoint. But, we're generally between 280 and 500 where we're taking profits. I mean, and it's just going to depend how offsides people get caught, how do government relations go, how does everything go. But the intrinsic value is there, and it's only going to get better. And during this down period, they gained share across their segments, and that's going to be reflected now that the shackles are off and this thing can go to town. So yeah, there's nothing to overthink. The reason you're overthinking is because price hasn't moved in a year, while the conditions and the fundamentals have. And that is a coiled spring. It's like holding a beach ball underwater, and when it finally goes, it's just straight up. And like we've covered with that Mammoth thing, you go from aversion, and then you go to like panic buying or whatever he called it. Paul Falcone, curious your thoughts on HZO Marine Max, a boat dealer operator. Margins are trending up over time, sales trending up, book value trending up. Business looks expensive, but they got a huge bump from the COVID. So trying to guess what normalized earnings might look like. Could throw this in the too hard pile. Curious your view on this situation. I think I looked at the wrong one. I looked at Malibu Boats, which is the same story, which I thought was kind of interesting. Let me take a look at this. What is it? HZO? I thought Malibu Boats was okay. HZO, but we don't own any and probably won't. Yeah, HZO. All right, let's pull it up here. Here's the analyst that was so pessimistic on Intel at 25, and then he had to upgrade it at 33, and now he's pooping on it ahead of earnings. So we'll see what happens. Maybe he'll be right for another quarter, but I wouldn't bet on it. Okay. Yeah, this one's growing, man. All right. What do we have here? Cash flow. Cash from operations is negative. They did an acquisition. So you got to understand how long that's going to take to be accretive. Free cash flow negative, so that's why it's down. I don't like that trend. Which boats do they have? They have Chris Crafts or something? What do we got here? New news, recreational boats, fishing boats, mega yachts, sport cruisers, motor yachts. Well, look, if you look at LVMH and Hermes, the game is just beginning. So I guess, high-end luxury and yachts never slow down. Let's just see here. Catamarans. I think you got to just go on 7 or 8 calls and start to look for bearish sell side downgrades. Look for the bear thesis on this. But let's see, it's trading off 60-70%. I'd probably be if I wanted to trade this, I'd probably be a buyer at 20. You'll probably find some support between 20 and 25. It doesn't really have enough margin of safety. I don't like the cyclicality of the business. But it seems like it's an okay business. So just get some understanding as to why it's cash flow negative and get some comfort in why that's going to change anytime soon. And it's probably okay, but not for us, but I think your thinking around it is right. I'd probably be more of a buyer of Malibu boats, to be honest with you. I think that one's a little more stabilized, but we can cover that in another podcast if anyone wants to send it in as a question. Tim Jenkins. Been a loyal listener to your podcast since mid-2020. Thank you, by the way. Thank you so much for your insightful commentary over the years. Would you please comment on the report that Buffett purchased Taiwan Semi and now sold it? What's up? Well, number one, he made money on the trade. Number two, he mentioned on his interview that he was one aspect of his decision was geopolitical. I think and it's part of the reason he doesn't own Alibaba and Charlie does, and Charlie hasn't changed his position, by the way, his most recent filing. I think it's still 20% of Daily Journal's assets. I think he just doesn't want to be in that political conversation. My guess is this was his Todd or Ted subordinates, and they put the trade on, and he said, I don't want this political noise. And they made money and they got out. And it's as simple as that. I mean, the fact of the matter is, and we covered this a while back, if he had any inkling that China was going to bomb Taiwan or otherwise, there's no way he would have his fate tied to Apple. If China bombs Taiwan, Apple's toast, and so is Berkshire Hathaway. So the better question is, why did he sell Taiwan Semiconductor and he didn't sell Apple? Is the better question. And the answer is, this is optics. As at his age, reputation is more valuable than profits. And I think he just wants to stay away from the China story at the moment. And that's all there is to it. And it was a subordinate trade and they made money and he used the opportunity to get out and call it a day. But if it was a real fear about Taiwan, I can guarantee you, he would not have as much exposure or even close to the same exposure because there's no difference between Apple and Taiwan Semi. If there's a problem between China and Taiwan, Apple is toast. And so is the market, and so is everything else. So if you want to bet on that, good luck. You're going to be like all these guys sitting in cash and treasuries, and when the S&P makes new highs, you're going to be chasing at 4,900 and get roasted. And I'm not saying you, Tim, I'm just saying you in the aggregate that are listening. But one last thing, I'll be in San Diego from May 4th through 6th, working from there. My daughters have a water polo match,
So any listeners or clients who want to grab 18, if you belong to a club or can get us on a nice track, I'd love to play with you. Just go to hedgefundtips.com and enter in the contact form. We'll hook up and get 18 in. Looking forward to it.
Anyway, this has been a great day. Want to thank everyone for tuning in. We'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now.